Okay. All right, we are live. Now let me know if you can hear me all right. All right. Gonna wait for somebody to show up in chat. Okay, great. Okay, great. Looks like we got some people in. Let me know when you're ready, and I'll go ahead and start going over heritage. And Mr. B, are you in here? I'm gonna go ahead and get a screen share up. Oh, hello, WASF. You're Sean, right? Okay, let me get the screen share up. I'm still fidgeting with it. Okay, here we go. All right, do you see that all right? All right, I'm seeing it on mine. I just want to make sure it's coming through on YouTube just fine. Okay, great. All right, I'm going to go ahead and hop into things then. So for those of you who were in Jeff's stream over the last few days, this is something that came up a few times, which was on the state of the Floridian property-casualty insurance market. This is an insurance company, HRTG, that does a good chunk of its business in Florida. It's a regional insurer. It's not a nationwide like a lot of the other major insurance companies, So Aflac, Geico, Progressive, Allstate. It's not a national one like that. It has its origins in Florida. I actually covered this stock on Seeking Alpha back in January, and I wrote it as a sell. I said it was an unjustified premium. In this case, I was referring to the premium for the stock. Now, if you look at what has happened since I wrote it, stock actually is still up from where it was. So it was at which price was it when it was at $6.39 a share when I wrote it. So it's still up, even though if we go back here, it has recently gone down quite a bit right as these storms have started to hit Florida. And so even though it did go up afterward, it actually started to go down a bit too. But even though it is still technically up from where I wrote it, I continue to think it was a risky investment, and that the rally that happened afterward was, especially when storm season is yet to come, did not make much sense. So first, I just want to see if people had any general questions about the insurance market over in Florida, or if they were like, some people had brought up the 60 Minutes story that was actually done on HRTG, that came out, I think, about a week ago. Mr. B brought it up in Jeff's stream. He was actually the main one who was asking about this. So if Mr. B were here, it would be maybe a bit easier to see what some more of his thoughts were. Mr. B, if you're here, please speak up. I'll wait for that too. Oh, this is what I'm working on right now. Micron. You got to use these flamboyant thumbnails if you want to get views. So, because if you look here, hold on. If you look at what people have been saying, buy, they think it's a great investment. I disagree. I don't think, at least so far. I'm going to look more into it, but right now I'm not seeing it. What I usually do when I prepare an article is I have like a hypothesis that I go with, and then I test it with my research. And if I change my mind in the course of my homework, then I'll change what the hypothesis is and change the title. But right now, my initial glance is that it couldn't be a bargain. Anyway, back to HRTG. The thing about this company is, if we look at its maximum history, right, we see that it had its IPO in 2014. So this is not a very old one, right? So if we look at like Progressive, it's been around a bit longer, right? Since the 90s. We look at Aflac, it's been around. Well, it might even go further than that. Seeking Alpha, I don't think, shows stock prices prior to the 90s, but so it's at least the 90s, if not sooner. Some companies are much older, but we'll only go back to like the 90s with their price on here. So if we go back to HRTG, it's only been around since 2014. What really supported its initial run as a company was that the Floridian insurance market at the time had a very favorable reinsurance market that helped insure. So basically, if you know how insurance works, right, they insure your policies, and then they get reinsurance to share some of their risk down the line and help them sort of mitigate some of their potential losses. And in this period, the Floridian insurance market actually had a lot of really cheap reinsurance policies that they were able to pile up on. And so they started out really well. But then over time, as storms hit Florida, it goes down, up to, and then we get to about here where I wrote about it. And I basically said, this doesn't make sense because the situation isn't really better. Now, it started to rally around here in the spring. I'll go back to 6-month view. So it started to, actually, let me go to 1 year. Yeah, so it starts to rally around here, and because this is when a lot of states, including Florida, are going to raise the ceilings on insurance prices, because unlike a lot of other industries, insurance in America is regulated on a state-by-state level. There's not really much national insurance regulation. And so usually the state insurance commissioner is the one that has to green light a price increase. What this means is that insurance companies, if there's a period of high inflation and they're covering property casualty, if there's inflation, property casualty goes up in value. What they were supposed to cover now becomes more expensive, and they get their margin squeeze. So the costs go up, the insurance liabilities go up, they become expenses once a claim is made, and then the price is still here. And then if they want to adjust, they're stopped by the commissioner in that state saying, no, wait, you can't until we say you can. And what's tricky is that if you're operating in multiple states, you might have to wait for several different commissioners to say yes, 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 yes before you see a huge improvement in your financial results. And then if you're concentrated in one state that's experiencing higher expenses and you're waiting on the state to give you more pricing power, that can be really crushing to you. And Florida is, in fact, probably it's kind of a joke, I guess, the perfect storm of problems for property casualty insurance. For reasons that seem obvious, and you almost wonder, why would people do business there? All right, let me look at some of the questions here. So, let's see. So WASS says, do most people in Florida have home insurance? As far as I can tell, they do. I'm pretty sure it would be very difficult to get a mortgage if you couldn't get insurance for your home, because that's almost always required. There might be a handful of exceptions, but I would err on the assumption that if somebody owns a home, assume they have insurance. Now, what might be possible, and this has been a growing thing, is that they start out with insurance, and then as insurance becomes too expensive, and these are private companies giving the policies, they are under no obligation to continue doing it. So if they're not allowed to raise their prices, they'll just stop doing business in that state. And that is a thing that a lot of insurance companies have done. Progressive's been doing it. Allstate's been doing it. They've been getting out of states like Florida, California, New York, where inflation drove their costs up, but they were not able to price effectively in response. And so, generally speaking, states where demand for real estate is higher and consistently growing are risky places for insurance companies to do business, especially because a lot of those states will say they tend to be blue states, and so they're more likely to have stiffer regulations on the businesses there, because if they don't limit the pricing of insurance companies, then the everyman voter is getting screwed over there. So they're very disinclined to allow price increases for the insurance companies. And the only thing the insurance companies can do is vote with their feet. So they just eventually stop doing business. And there's sort of this ebb and flow where eventually, if not enough insurance companies exist to have reasonable coverage in a state, that's when the commissioner will have to allow increases. Insurance was not a bad business over the last decade because there was almost no inflation. And so that was another thing that helped a company like Heritage, is that they started out with a very favorable reinsurance market, and inflation was extremely low. It was near zero for a straight decade. And when suddenly inflation starts shooting up, which happened in 2021, 2022, and then you had major storms as well. 2018, there were some major storms, but 2022 is when you had Hurricane Ian. Those things really started hurting companies like Heritage because of their concentration in Florida. And Florida is especially bad because while their state government has shifted more toward being a red state now, not really a swing state anymore, some of the advantage that might create for businesses there, if we assume that means their insurance commissioners will be friendlier to business, is that it's still an area that has a lot of real estate that's constantly in demand. People are constantly moving to Florida, increasing the demand for it. And Florida is basically like a middle finger sticking out in the Atlantic. It's just asking for hurricanes to hit it all the time. So you have highly demanded property, constantly getting bombarded by storms year after year, and you're the person that has to put the claims if you're doing insurance business there. It's a terrible place to do business, and it's crazy that a company would have been started with the idea that you can primarily do insurance business there, and not even like diversify in the other states. It's just, but that's the history with Heritage. So if you want to look at like the history of the financial results, I'll show you like what I covered here on, and it's not just Florida. So I mean, they basically have the Southeast, but like, is this really diversification? No, because these are all like this is the magnet for hurricanes right here. So even if it's spread out in other areas, they get a lot of claims. Like I'm in North Carolina, we've been hit by a lot of storms recently. I'm sure you've heard about the devastation in the Appalachians that happened recently. People are going to be paying up for this stuff. So if we look here at okay, yes, here we go. Here's the charts. So if we look here, we can see that revenues did increase over time, but their earnings actually declined. So even though they are doing more business and they were growing their business, their earnings quickly turned into losses. And if we look at the impact of the tangible book value, so this is basically if you were to liquidate the business with just its tangible assets. So you don't count intangibles like licenses or patents or trademarks, things like that. Just anything that has cash value. So this could include bonds and other fixed income securities on their balance sheet, any cash reserves they have, things of that nature. This was the peak value of the business based on that was in 2015. And as storms started hitting, earnings started dwindling, because basically, any earnings that aren't distributed stay on the balance sheet, and it should be increasing this value. But that has not been the case. And you can see it's getting narrower and narrower. If we actually look at it in terms of just assets and liabilities, look at how much this spread has narrowed between the two, right? This is up till the end of 2023, right? So this is not including the year-to-date data. But that's why I was nervous about it. And if you look at some of the comments here, there are people taunting me. Nice call, up 130%. This was right before the storm started hitting, so this was accurate at the time. Blowout performance from business perspective, which should be followed by blowout performance for pricing in equity markets. This was back in March. Again, that to me that was premature. And someone eventually asked for my opinion on something. I'm trying to find this, so I had a response to it. Okay, yes. Patent Man said, Mr. Parrish, be sure to check back here in about 2 months, and then in 6 months, and for a final time in 1 year. HRT earnings will start accelerating upward with the upcoming Q4 report. The stock is a very strong buy, in my opinion, and great timely buy right now. And I said to him, I'll check in after the next major storm or storms hit to see if their balance sheet can survive it. And he said, your reply is telling, not in a good way. But yes, please do check it back after a big storm or hurricane. There have been many since 2012, and the company today is stronger than ever. Again, that's not true. We saw their balance sheet. It was incredibly weak. Like, that was a company, if they were stronger than ever, assets and liabilities would have done this, not this over time. Like, so much like comment sections anywhere, even on Seeking Alpha, people on there want to flex a bit or throw punches in those. So, but just, the numbers don't lie here. He can say what he wants, but yeah, financial results are financial results, and there's a reason why over the course of a decade the stock mostly went down. And this, I think, was just an overly positive reaction to the fact that Florida was loosening its pricing controls on insurance companies there. But that doesn't, increasing the upside in Florida does not eliminate the risk. And this is why I think it's an important stock to look at, because it's a classic case in risk management and how you as an investor, right? Because if the management of the company isn't going to manage the risk better, you as a shareholder or a potential shareholder can manage your risk better. Let me take a look at some more comments. This was already asked, but I don't think can you get insurance against climate change? So I don't think you'd be likely to find a policy for that. And I think one is that it's likely to be very expensive if you did get it, because it's such an ambiguous thing. And then I think they would come up with any excuse in the book to say that your specific claim, your incident, was not an example of climate change. So insurance companies generally like to underwrite insurance, especially if they're a good insurance company, on things that are very easy to calculate. Now, there is this growing industry of specialty insurance for property casualty that basically covers property casualty insurance that isn't as well understood, for which there's not as much data or not as much customers. And what they do is they just write really big prices on those policies. And they say, hey, if you want to have insurance, this is what it costs. So they do an all right job. If you remember where that video I streamed with Jeff in the second episode of this stream series, Howard Marks talked about how some of the most profitable businesses are life insurance companies, and they write policies for people, all of whom they know are going to die. So it's like a 100% risk guarantee over time. How do they make it work? Well, they manage effectively, and they do that through pricing. And so the issue here is that with life insurance, it's currently the case that it's easy for them to price effectively, and then it's not as, a life insurance payout isn't as subject to inflationary pressures as property casualty, right? And then there's, so property casualty is inflationary in the sense that the materials used to make a repair become more expensive. And then also, as materials to build things become more expensive, those tend to increase real estate prices, because essentially the existing real estate is compared to what it would cost to build something new. And then if it's also a place like Florida where a lot of people want to live because it's as close to a tropical place to move without flying all the way to Hawaii, then that's also going to push things up. Life insurance doesn't have those kinds of pressures. And it would take like some sort of major deadly event for life insurance to blow up in a life insurance company's face. And over time, the case has been that people are living longer, so they're less likely to die, and they're much more likely to be premium payers. So you have a much longer runway. Like your contract per person has a much longer runway of time to collect payments before you actually have to pay anything. And so there aren't the same pressures here, right? So they manage their risk much better, even though they know that every single one of their policyholders is going to die. Whereas with property casualty, some homes may never be damaged. They may never have a claim against them. 200 years could go by, not even something to, fix one floor tile, or one gutter that gets dislodged, right? Not even something minor like that. It's all about risk management. And in my view, the reason why property casualty, though, does get insured, even though it's so risky, is because the companies there at least feel like they have some sort of gauge on what it is. There's so much data about the Floridian real estate market, about home prices in general, about accident rates and how they can track that by demographics, that they think they can price it effectively. They are often wrong, or they are maybe making long-term bets that they will take bad business now in the hopes that Florida will let them raise prices soon, and then they can keep those customer relationships after they raise prices. Maybe they're doing that too, but that's not effective risk management. And I can't imagine anyone selling climate change insurance policies unless they are charging you an arm and a leg for it. So I mean that's what I think. So yeah, if we go into what happened recently, well, first I want to look right around. Where is it? So we look right around here that we notice that go back 5 years. Yeah. So if we look right around here, we notice that the stock took another sharp dip, and it also started to go down a bit here. And here in particular, where it starts to decline in September, it doesn't look like much, but you got to figure from 281 to 132 is more than a 50% crash. So that's bigger than this, technically. Proportionally speaking, this sharp decline we've just seen, this is a bigger crash than that, even though it looks smaller. This is when around the time Hurricane Ian hit. And so when Helene hit, that's what triggered this. And now I'm going to go back to a shorter span of time. So Helene hits, this happens. We wait a bit for Milton, and then we're like, okay, Milton is definitely going to hit Florida, and now look at it when the market opened this week. I wanted to buy puts on this. I said I would. There was no market for puts. I looked at it, nothing. They were too scared to write a put price for the first hour or so. By the time someone was finally selling puts, they was hugely overpriced. So they were writing better insurance than Heritage, I suppose. Okay, Mr. B, are you here? Mr. B. You are the one that wanted to see this, and I do not see it. All right, so let's take a look at some things that'll probably be indicative of what things are like in Florida. So, Florida real estate prices. Let's just look at that. Okay, so if we look, look at this. So this is when Heritage starts. This is still under where it was prior to the bubble, in the big bubble that burst before the Great Financial Crisis. It's still below this, and this is when Heritage starts. And look at what happened to real estate values now. Right. So this is, this is the property value has more than doubled. So the risk that Heritage got more than double. That's what this means, because that's what they're insuring, right? If this is what the value is, and you have a policy for it, this is what you're gonna have to do. And it's in a state that's just getting bombarded by hurricanes. And to me, it's just strange that people could look at this, know this is still the case. It's not like this went down, right? So if we look at what happened here, this double from 740 to 15. If this suddenly went down again, I could see this. I could see why this would happen, because the risk is lower. But that didn't happen. They got marginally better pricing power, and people act like the company is just going to take off into the skies. Makes no sense to me. Well, no, Mr. B said that he would be, well, so he did initially say that he would be there, I think, on Wednesday, but it is possible he's trying to escape now. You are probably right about that. So anyway, I hope he comes along and catches up, or at least sees it later. But yeah, Mr. B, I did not buy a put because the market was too scared to sell any. I really wish, because would have been a great. I think I could have gotten some on Friday. I was too slow, but that's why I'm working on my option strategy, and I don't put much money into it. I've got a few other options plays in the works, but they're not like huge capital commitments, and they really shouldn't be. You should have most of your money in good stocks and only be doing very well timed options trades with maybe 1% of your capital at most. So WASF. I mean, you've got my ear since you're the only one present right now. Are there any other are there any pointed questions you'd like to ask about Heritage? Because if not, I think I've probably explained everything there is to explain about the risks here with doing business in Floridian property casualty insurance. And I might move on to something else. I just want to see if you have other questions. Nope. Okay. So great. So we'll fold the page on that for later, and let's take a look at Micron. So this is a company about which I don't really know anything because I've just seen it coming up. And if you look here, a lot of people are saying that it's a buy. I'm initially skeptical because one, I just noticed that if everyone says it's a buy, can it really be a buy then? And two, if you look at the headlines here, an outrageous AI growth bargain, one of the top picks in the AI hardware landscape, riding AI tailwinds amid memory market headwinds. So if you ask me, what's the opportunity here, right? If we look, we can see that that the business is worth $114 billion based on the last quote. So the shares are 102, but if you take all the shares that they are at this price, it's 114. That's it. That's the market cap. Then we have to ask ourselves, does this business make enough money to be worth $114 billion? And you can take a quick look to get a general idea of that. So I actually did pull the financial data on this already. So here's the revenues of the company over the last decade. You see it looks like it's a textbook cyclical. And where the revenues tend to do this, right? It has a more exaggerated impact on the cash flow. So this is the free cash flow. Does anyone need an explanation of what free cash flow is? AI did take jobs, but not mine. If AI took your job, then subscribe, and then you'll at least have something to do while AI is doing the job you once had. And maybe you'll get some ideas. Okay. All right. So free cash flow is, since I assume that means yes, you need me to explain it. It's related to this concept called owner's earnings. Warren Buffett developed this idea, and you might be aware there's like reported earnings that a company sends to the SEC, and then when they do that, they also they do it publicly, so the whole investing community can see it. And this is legally required. And these are sort of like, it's like what their reported earnings would be for tax purposes. It's called GAAP earnings usually. GAAP is GAAP, generally accepted accounting principles. So accountants know what all the generally accepted accounting principles are. And so there's a lot of technicalities in them. Some of them are useful in understanding what a business is really worth, and some of them are just technicalities that allow you to do certain write-offs or add-ons or anything. For some businesses, GAAP earnings are a good indication of what the earning power of that business is. For some businesses, they're not, and you have to, we'll say, reverse engineer some of the additions and subtractions to get free cash flow, which is basically taking out certain non-cash items and just getting straight back to how much cash did this business generate. If you understand how much cash it generates, then you can know what the business is worth. If you compare a stock to a bond, for example, you know what the free cash flow is. It's the interest. So you can value the bond based on the interest. And you could say the principal as well, which you'll get back at maturity. Right? So with a bond, you're not valuing it based on non-cash considerations unless it's some sort of interesting perk that's written into the bond issue. So if it says it'll pay this much interest, plus you have maybe you'll get an option to buy the stock of our company at a certain price, maybe that can influence the value of the bond, and it's not exactly a cash form of value. But anyway, I digress from that. As we are comparing stocks to bond as cash flow instruments, you have to calculate free cash flow yourself by looking at the financial records and the history, getting an idea of what is normal for that business, what is doable, so that you can determine what it's worth. Because just like a real business, like when I say real business, I mean like one that you start yourself. Like if you're going to start a hot dog stand, all that matters to you then as an investor in your own business is the free cash flow, right? After you've, sold hot dogs and spent money to make that business manageable, what margin are you left with? That's your free cash flow. And you would know what your business is worth based on that. So that's why this is important. So if we look at Micron here, it has positive and negative cash flows. So right now it's like barely breaking even compared to what it's done before. And you might wonder, well, what's the reason for this? And what's the reason for the optimism? So if we go back up here, we can look at capital expenditures. So capital expenditures are cash outflows for anything that adds to their property, plant, and equipment in that year, but isn't written as an operating expense. So there are additional expenses that do not count toward GAAP earnings. GAAP earnings is after you subtract all operating expenses. But a capital expense is not treated as an operating expense if it's for any addition to the business whose use is longer than a year. Operating expenses are only for expenses that are specifically intended for things that would occur in that reporting year or that calendar year. So that's why you often have to tweak things with free cash flow, because there's a lot of CapEx that's outflow that would not be calculated in earnings. And if we look here, the CapEx is pretty large. These are the operating cash flows, by the way, cash provided by operating activities. So net cash provided by operating activities is basically net income after you work out all the non-cash items. So like if you have an asset that goes up in value, that can be counted as earnings, but you don't actually get any cash for it. You just report a higher value on your balance sheet and it's treated as earnings. So that's one example. And then any write-offs that aren't due to cash, something goes down in value or something gets destroyed, you want to write it off as a loss. That's not a cash item either. So that doesn't count. So basically operating cash flows is net income corrected for any non-cash items. And then CapEx is the outflows from any expenses that could not be written as an operating expense that year. And if you look here, CapEx is usually pretty close to the operating cash flows. And we see some years they're much higher than others. So here it's about $4 billion. So my tables are usually in millions of dollars. And so it's usually keeping up. Sometimes it even exceeds operating cash flows. So usually the years where it's negative free cash flow is when the operating cash flows decline, but the CapEx doesn't really. So that's the issue there. So it's good to understand what causes this to happen. I mean, one obvious example here, if we look at 2023, for example, is that the revenues declined by about $15 million. And if we look at the operating cash flows, they declined by a similar amount. So some of it is just the fact that what it costs to run this business doesn't change as easily as their ability to sell products. And so it might be worth looking at what caused this to happen here in fiscal 2023. And it's worth noting that their fiscal years end in August. So they're not reporting periods ending on a calendar year, December 31st. They're doing it on periods ending August of that year, August or September. So yeah, the annual results for this business literally just came out because they usually take a month or two before they release them once that period ends. So this is fresh off the press. This is the most recent financial data we have. Check comments again. Nothing new. So WASF, please throw in questions if you need better explanations for all this, because I recognize this may not be as instantly digestible to folks. It's not difficult stuff. It's simple addition and subtraction. Most people think to be an investor, you got to do all this weird calculus. You don't, and you really shouldn't be. But there's a lot of words here, different variables that you add and subtract. You can get lost in the details. I know that if you're not, it's more the trivia aspect of investing than the complicated mathematics of it. You got to learn 12 words at once sometimes. Okay, I don't see any questions yet. So yeah, I'll proceed with looking at it. So what I want to do is, this is the investor relations page of Micron. I want to look at why revenues declined so much that year. So there's a good way to find that out. We've got to go to the 10Ks they have. So where do I want to click? I'll click here. No. See, view all materials. Let me look here. Okay, 2023 Form 10K. So I'm just making a new tab with that. This is the 2024 one right here. And so usually if you want to find why revenue declined, if you look in the management's discussion and analysis of financial condition and results of operations, you will in fact find an explanation of that. So membrane storage industry deteriorated sharply in the fourth quarter of 2022 and throughout 2023 due to weak demand in many end markets, combined with global and macroeconomic challenges and lower demand resulting from customer actions to reduce inventory levels. So my guess is that they were reducing inventory levels is because of inflation, and they could not raise prices fast enough to cover the cost of accumulating inventory. So they just stopped taking on inventory and were trying to wait inflation out. This led significant reductions to average selling prices for both DRAM and NAND and bit shipments for DRAM, resulting in declines in revenue across all of our business segments. So this is an interesting thing here. It's it wasn't so much a volume issue for them as it was a pricing issue. Their revenue went down. Usually there's two fundamental things that will make revenue go up or down. You either have more or less volume at the same price, or you have the same volume at a higher or lower price. So for them, it was more of a pricing thing. They just, in order to make sales, they had to take a cut. So they had to write down inventories to their estimated net realizable valuable. Ongoing demand growth, customer inventory normalization. Just looking for any new clarity here. A challenging pricing environment. So that should tell you something else. Generally, really good businesses don't have challenging pricing environments. Usually, they can just price what they want if their product is really good and the market for it is good. Really good businesses, even if they're in a business that's in an industry that's in decline or in a cyclical downturn, if they're really good businesses, that's an opportunity for them to capture market share and potentially grow, just because their pricing ability is still quite strong. Here. 2023 restructure plan. We initiated a restructure plan in response to challenging industry conditions. Under the plan, we expect our headcount reduction to approach 15% by end of the calendar 2023 through a combination of voluntary attrition and personnel reductions. So that's a pretty big cut. That will likely impact their operating results. We can actually look at the 2024 financial results to see if that's what they did. Let me actually go there right now to see if they delivered on that. Go to table of contents. We go to financial results, and then we go to statement of operations. You can look at the expenses. So, research and development up. Selling general administrative up. So it is not immediately clear to me that they successfully reduced their headcount to cut expenses because expenses are higher. That doesn't mean that they didn't do it. So let me see if we can look down here. Any other? So I might need to see a breakdown of their expenses elsewhere, because settling and general administrative expenses doesn't necessarily payroll, although payroll is going to be a lot of that. If other expenses increase more than the payroll reduction, that might be why we see the cost increase. So we're going to have to look at that. But as you can see in my approach here, this is why you look at the data. So what they do and use it over. I'm guessing there's some typos in there. Could you just restate your question? I think I know what you're asking. I just want to be sure before I go into another 10-minute speech on it. But I was going to say, as you can see, when you just look at the financial data and you see what the trends are, you can begin to ask yourself the right question. Why did revenue go down? What was their response to it, right? So you can just see where I'm looking, and it helps me sort of know what I want to know for my thesis. So I'll go ahead and tell you ultimately what I'm looking for on something like this. So I have a rule of thumb that when a company has a market cap, and we'll say it's a non-financial. With non-financials, I look at different things. When I look at something like this, I want to see that there is a pathway to it earning at least a tenth of what the market cap is. So what I would want to see is that Micron can make about $11 billion a year if it's priced for 114. I want to see that that's going to be just a normal level of free cash flow. So when I look at the history here, I can see that isn't the case. It makes me, ask some questions about it. Right? The most it ever was $8.5 billion, and that was in 2018 before the AI boom. Now, here we see in the sort of like early stages of the AI boom, this included an outflow of 6.1 billion, and then with a full year of like AI boom, it barely breaks even. So what are they doing? This is a net, free cash flow of $121 million. So for a company that made $121 million, why would I want to buy it for 114 billion? Because if I buy one share for 101, 102, that mathematically that's the same as buying it for 114 billion, right? Because this is connected to this. When this changes by the same amount. So whether I buy one share or all of them, why would I want to spend that much money on it? And right now, I'm having a hard time seeing it, just given the cash flow history. I'm going to need to see more about what's going to increase revenues while expenses stay lower, right? What's going to create upside while the downside remains fairly contained? Is it going to become a more capital-light business? Are they going to unlock some sort of pricing power they didn't have before? Those are the questions I have in mind. Or can they successfully reduce their expenses faster than they have before, and then create just a bunch of additional earnings that way? And even so, like if we look at what the earnings have been, let's go to the 10K again. I want to look at the right chart here. So go here. So if we look at what their expenses are, most of their expenses are their cost of goods. So this is in the gross margins. So they're, we look at, they have tens of billions in annual revenue usually. Most of that is just spent on basically building up the inventory. And then the other operating expenses, so the R&D, the sales team, the other workforce, there may be other expenses like, power bill, leases, things like that. Those are just a few billion. Most of this is the inventory and what their cost of goods will be. So the question is, can they get cheaper goods on here? But otherwise, the thing that they can most easily control, I think, is these expenses, and that's only a few billion. So if I want to see that they'll make 11 billion, and the best they could do in theory is get all this down to zero, that's the way they can increase the floor 5 billion a year. That's still not enough to see, so there has to be some sort of growth story here that this is going to go from 25 to I guess 35 or 36 billion a year, while this and this stay where they are. That's what I need to start seeing here, and that's just going to be the case going forward. And optimistically, that's going to be the case. I mean, pessimistically, that's going to be the case. I don't want that to be the assumption of, if things go perfectly, then it's a fair price for the business, right? Because if things don't go perfectly, well, then we know what happens when things start to get better, and then suddenly costs and risks materialize. We saw it in the span of a year with the HRTG. People said, "Oh, it's going to be great," and then, boom. If you really believed that things were finally going to be a new golden age for heritage, you are down about 33% or so. So we have so we actually do have 1 month roughly aligns with the peak. It is a 39% decline. Okay. So most people would be unhappy with that, especially if it hinged on on the company doing better. So we have to ask ourselves the same thing about Micron. Okay, so what do they do, and are they overvalued? A good question. So my initial indication is that they are overvalued. So if we want to find out what Micron does, we've got to look at the annual report again. And the Form 10K, this is always the first thing to look at if you want to know what a business does and just get an initial handle on it. One of the good things about the federal government, I will say, if there's any good parts of it, is that companies are afraid of the SEC, and they tend to give pretty informative and accurate reports to them. And so the SEC might be the most valuable agency of the federal government out there, just for that. The fact that it can provide that level of increased certainty for investors in a highly uncertain world. The business overview. They are an industry leader in innovative memory and storage solutions, transforming how the world uses information to enrich life for all. With a relentless focus on our customers, technology leadership, and manufacturing and operational excellence, Micron delivers a rich portfolio of high-performance DRAM. So this is, forget what the D stands for, but this is a random access memory type of thing, NAND and NOR memory and storage products through our Micron and Crucial brands. Every day, the innovations that our people create fuel the data economy, enabling advances in artificial intelligence and computer-intensive applications that unleash opportunities from the data center to the intelligent edge and across the client and mobile user experience. So they provide basically some form of computer hardware that assists in computer processing, and the idea is that their hardware can take on a higher load, I think, than of that. Do I know the specifics of how that works? No, because I'm not a tech guy. I'm not an engineer. But I can, at least generally understand what role they play in all this, in the AI economy that is forming. There's a hardware and a software side of it. Some companies have their hands in both. Some have their hands in just one. And theirs is more on the hardware side. If you feel like you understand more about the nuances of this deal. So, the weakness for me here would be, what are subtleties? Like, could I tell you what a better hardware computer memory product would be with another? If you showed V2 to compare, probably not. Right. So for me, I'm going to need to see more of a really good valuation, right? I don't necessarily need to understand perfectly. I just need to know that the market's going to want need what they make, and that the price on the market. So when I say the market, I mean customers. Then the price on the market, the stock market, is a discount to that bright future. Right? It can be fairly valued for a pessimistic future, but it needs to be a discount to a bright future. So that's what they do. They manufacture their products at wholly owned facilities and also utilize subcontractors for certain manufacturing processes. Global network of manufacturing centers of excellence not only allows them to benefit scale while streamlining processes and operations, but it also brings together some of the world's brightest talent to work on the most advanced memory technology. Centers of excellence. And this is a pretty important claim here. Most advanced memory technology. So they seem to believe that they have some sort of industry-leading product. Centers of excellence bring expertise together in one location, providing an efficient support structure for end-to-end marketing with quicker cycle times in partnership with teams such as research and development, product development, human resources procurement, and supply chain. For our locations in Singapore and Taiwan, this is also a combination of bringing fabrication and back-end manufacturing together. We make significant investments to develop proprietary product and process technology, which generally increases bit density per wafer and reduces per bit manufacturing costs of each generation of product. So these things are probably important here as well. Again, even if you don't know a whole lot about technology, most people know that bit density would probably be important, right? So the more bits, we're in the huge numbers with bits now in terms of processing power, right? Getting to like giga and everything and tera. So basically doing more with less hardware and also reducing the cost per bit, right? So extra value to the customer here is what we want to understand this to be. And then this is where the lower risk profile could be. We continue to introduce new generations of products that offer improved performance characteristics, including higher data transfer rates, advanced packaging solutions, lower power consumption, improved reliability, and increased memory density. We face intense competition in the semiconductor memory and storage markets. To remain competitive, we must continually develop and implement new products and technologies and decrease manufacturing costs in spite of inflationary pressures. Our success is largely dependent on obtaining returns on our R&D investments, efficient utilization of our manufacturing infrastructure, development and integration of advanced product and process technologies, market acceptance of our diversified portfolio of semiconductor-based memory and storage solutions, and efficient capital spending. So this here explains more about the individual things of what they do. So RAM, NAND, and NOR. I might not even be pronouncing these correctly. Let me check the chat again. What do you think about UBI? Because AI will take all of our jobs. Sure, I'll put a pin in this for now. So I'm generally of the camp that we would need some sort of UBI if job deletion from AI and other forms of automation occurs faster than our ability to create new jobs. Essentially, what would have to happen is a lot of folks would need to move into some sort of freelance creator economy, almost like you're seeing right here with what Jeff does and what I hope to do on YouTube, at least. I kind of do that on Sigma Alpha by being an analyst and publishing articles there. So my main incentive for writing about Micron is that I'll be able to produce an article in which I have an opinion on this as an investment and get paid for it. And that's it's an alternative to just me having a normal 9-to-5 job. And I suspect that will become more common as AI destroys jobs. And we still, AI doesn't really work if jobs are destroyed and the savings it creates aren't utilized because people don't have incomes, right? So some form of UBI would be needed to address that. You would need to continue to grease the wheel of the economy somehow. Just make sure that the blood is pumping. Like if the heart pumps all the blood to one part of the body, well then the rest of the body dies, and then with it, that one part of the body that was getting all the blood dies too. So something like that would have to happen if AI takes off, too quickly. That's assuming it goes like that. So it may not occur that way. It may be sustainable. In fact, it may be that business advancements don't happen beyond what is sustainable for consumers, right? So if AI is advancing beyond the ability of consumers to enjoy the advantages of it, businesses may slow down what they automate, because if it can't sustain itself, that could happen. Of course, it could also lead to some sort of like AI bubble or implosion event like 2008, where we were steadily heading off the cliff, but no force existed to stop it. So I don't know where the AI boom will be self-correcting, or whether it will result in another 2008 type event. Right, that was with housing market and not something really based on new technology. In most eras of history, new technology has created new jobs. It's caused a lot of social upheaval. Like, people went from living in the countryside and working farms, working land, to bunching up in cities. Most previous advancements in technology were much more physical. They were much more capital intensive, so they did not happen as quickly, even if, historically speaking, they were pretty rapid changes. So much of AI happens in information space. It doesn't require, right? Like, so the invention of the diesel engine doesn't really transform society until you have a lot of paved roads built, and that takes time. Because even if you have a diesel engine that can make some of that easier, you still make guys go out and dig holes and and throw out their backs, making thousands and thousands of miles of road. And then once you have that laid down, diesel engines can be used to just go all over the place and speed up the economy. AI is not quite as limited in that regard. All you really need to add is data centers. And, you can have just a handful of data centers in the country meeting all the AI needs. And it's a very immediate benefit. So if you look at like what Palantir has been able to do, because their business has been in data analytics, and now they've hybridized it well with AI. Almost overnight, they're helping companies see millions and millions of dollars of cost savings, like just things in their business model that they could not have seen with human eyes, that they can see with data analytics. They can now implement. A lot of that's going to be probably job elimination, just seeing redundancies in their models. Right? If things are wasteful, then they reduce the waste. That probably means whoever's job it was to do that waste doesn't have a job anymore. So if you're overstocking an inventory and you didn't realize it, well, now you need less people to stock inventory. So you don't just spend less money on inventory, you spend less money on payroll too, right? That I can see happening a lot faster, because companies can just more quickly move on that than before. So I mean, that's what I think. Whether or not, even if it's necessary, whether or not we will have the political will to implement UBI is another question entirely. In my view, I don't think the electorate shows a lot of openness toward solution-oriented thinking anymore. I think a lot of voters are motivated by trying to stop the other side. So the only way I see UBI getting passed is if leaders on their own decide that they want to do it to solve some sort of problem. And if somehow it doesn't become a partisan issue. Right now, I don't think UBI is particularly partisan. Like, it's not a thing that's heavily associated with one side. And I think that's the only way anything gets passed, is if neither voting base cares enough about it to complain about it. Which is ironic, but I think that's the way the system works. Okay, we are about an hour into the stream now. And I basically covered everything there was about Heritage and also gave some insights into how I start looking at a stock. I probably want to finish up on Micron. Did you have any other questions before we finish up the stream? Okay, great. Well, thanks for joining in, WASF. I'll see you around in the other streams, and then, so Jeff's, I guess, and then future episodes of this as I put them out. So yeah, if you ever have any ideas, just let me know wherever you happen to see me, and then we'll talk about that stuff then. Okay. All right, good end the stream now. Thank you.